Hi, it's Mike Howard. Welcome to my video on retirement planning. I want to talk to you a little bit about how what I do figures into your retirement planning. A lot of what I do and that I recommend are what they call fixed indexed annuities. They are simply programs issued by insurance companies that allow you to make excellent returns with virtually no risk. Now I say virtually because it's nothing 100%, but it's very, very close. As a matter of fact, for every dollar that they guarantee to pay out, they have to have a dollar in reserve. And the state of Georgia requires that. It's not something they suggest or ask them to do. It is an absolute must. So the money is very, very safe in that respect. And I don't ever remember or know of anybody that's lost money in an annuity. There possibly could have been somebody that dealt with a little bitty tiny company years ago that had some problems, but I don't think so. It's possible. I won't say that's an absolute fact, but I'm certainly not aware of them. And I can tell you in the 32, 33 years that I've been doing this, nobody ever has. Particularly I know in none of the companies I've ever represented. And I do know some companies that did have some financial difficulty, but even in those worst of circumstances, the people still were paid the money from their annuities. So that gives me a great deal of comfort in coming to you and making a recommendation like I do. Now, in retirement planning, diversification is important, so I'm not recommending that everything you do for retirement planning should be in annuities. That would be crazy. You should have some stocks, some bonds, maybe some real estate, some other type of investments that you are comfortable with. But what I am saying is part of everything that you do in retirement planning should be in annuities for several reasons. One is their safety. One is they don't go up and down like the stock market does, where you lose money. Once you make money with them in a year, that money's locked in, can't be taken back away from you. Now, I'm not speaking of every single product out there, but the ones that I have, I know are like that, and most others are as well. The chance for returns is excellent. I was just looking at one the other day. I got in on one of my clients. The annual report, it made 17% with no chance to lose that money. Now, that is very significant. So here you are with a situation where you can make excellent returns but don't have the downside of the stock market. Let's say, for example, you've had 2 or 3 good years in the stock market and maybe you've made 20% a year or better. Now the 4th or 5th year you have a 50% downturn. Well, you just lost most of your money. And yeah, if you're 35, 40, 45 years old, you got time to recover from that. But does that even make sense? Saying that you have time to recover. What if you don't have to recover? What if you still make good money, but you don't need recovery because you never had the money, the years where you lost a lot of your money? To me, that makes a lot more sense, because if you put a pencil to it, and I have, not losing money over a given period of time is way more valuable than making lots of money in certain years and then losing it again in other years. Do the math yourself. I think you'll find out that that's the case. Give yourself some time. Give yourself 10, 15, 20, 30 years. It works that way. But now, most of my clients are 55 and older. Well, at that age, you don't have that time to recover if you're ever intending on retiring. Now, if you're never intending on retiring, I guess it doesn't make much difference anyway. But if you want to be financially secure from the money you're accumulating and that you spent a lifetime accumulating, why put it to risk when you don't have to? Yeah, have some of your money at risk, the part of the money that you feel like you could lose and it wouldn't kill you. That's fine. That's where diversification comes in, and you can even be a little more conservative with some mutual funds and some bond funds. Yeah, but those are pretty good. And when you see the market going south, go ahead and make some changes. Many financial advisors, let me say stockbrokers that I've talked to, and I know a lot of them, will always tell you just hold on, it's coming back. That's not necessarily true for you. Yes, the market will eventually come back, but will it come back where it helps you? Let me give you an example. Let's say you're 65. 60. It really doesn't make a lot of difference. You need to be 60 or 65, I think, for this to make a lot of sense to you. You're getting close to that retirement age, and you've lost money now. Just what happened in 2001, somewhere you lost maybe half of your money. A lot of people I know lost 30 to 50% of their money during that time. Now, you retire. Well, your money pot has been cut way down. So if you're in mutual funds at that point, you've got to sell off more shares in order to get the income that you needed. So since you've got to sell more shares, when the market does come back, you don't have those shares to enjoy the growth. So the market doesn't come back for you. Yeah, it may help you some, but it doesn't get you back to where you were, because now you're drawing out money. You're not putting in money in dollar cost averaging like you did when you were 35. Now you're 35 years old and you're putting some money in a 401k every week that you get paid, and the market goes down. That can be a good thing for you. It really can, because now you're buying more shares because you're dollar cost averaging, and when it does come back, you've done well. I have no problem with that, and that makes sense. But if you're not 35, if you're 60, 65, even 55, and you're wanting to retire on your accumulations, you can't put it at risk and expect it to last as long as you do. People are living a lot longer, and they've got inflation to deal with. So here's an interesting number for you. About 30 to 35% of the people that are age 65 today will live to 100. Now that's increasing a little bit every year as we go along. So you can look forward to living in retirement a long time. Now that's going to take a lot of money, but if you put your money at risk, or at least a lot of your money at risk, you could be left with no income. Don't do that when you don't have to. Yes, diversify. Have your stocks, have your bonds, have whatever else that you want to have. Even real estate, as you've seen, is not the perfect investment. We've seen tremendous swings in that in the last year or two. But put some of it away in annuities that's guaranteed, so you won't lose it. That can be the backbone of your financial plan. And then if you do real well in stocks, that's just a plus for you. You don't have to go risky. And that's what happens. A lot of times when the market turns on people, they go even more risky, trying to make it up. That's the wrong thing to do. Most people should not do that. There's a few people that win, but it's like going to Vegas and rolling the dice. Most of the time you're going to lose there. That's the reason Vegas is there. They don't make their money off winners. They make it off losers. So, for retirement planning, take a look at fixed indexed annuities from a very large life insurance company. I hope you'll call me, because I've got the companies that I do that with that I know are very financially sound, and you're protected. Give me a call, email me, whatever you like. You can just take this email that you got and send it right back to me, or contact me at my office. You're looking at this because you probably have some information from me anyway. But if you don't, my number is 478-738-0331, and my email address is m.howardthg@bellsouth.net. I look forward to hearing from you, and thanks for listening.